Good morning, everyone. Welcome to this update for Australian and global stock markets for the 14th of June. There hasn't been a lot happening of late. Markets seem to be stuck in a bit of a sideways range now for quite a few months. There's been some disruption in the bond market. Is this the start of a major sell-off in the bond market after something like 32 or 33 years of a major bull market in bonds from the 1980s? Or are we going to continue along with things as they have been since the GFC? I don't think anyone knows the answer to that question, but certainly what happens in the bond market, whether there is a sell-off just starting, is absolutely key for stock markets, that's for sure. So very important aspect to watch. So let's get on and have a look at what happened over the last week. The S&P index was essentially flat on the week. I think it might have gained a point. And we're in this typical nervous June period that we quite often see in the American market. And as you'll see from the chart, there's really no change to the overall coiling pattern that has been in place now for most of this year. A volatility breakout, as I've been saying now for some time, is inevitable. The overwhelming odds are that it will break out to the upside. However, I do not rule out the possibility of a breakdown to the downside. There are two major triggers. The lesser of them would be a failure of Greece to meet its debt repayment obligations to the IMF. I think everyone's getting pretty bored with that Greek story now, so I think the impact of that is probably going to be lower than it was a few months ago. But the major one, of course, is the bond market. If the bond market does sell off, and particularly if corporate bonds start to sell off. At the moment, there's a bit of a sell-off in government bonds, but if that starts to occur in the corporate bond market as well, then you're going to see a fairly substantial impact on stock prices. So I don't discount the possibility of a break to the downside, but I think it's a low probability in America. So the stability of the market is really all about bonds. And again, as I've been saying over and over again for nearly 2 years now, I'm a little bit nervous about many sections of the American market. So I'm not just blanket positive on America, but on the selected sectors, and for those, obviously members understand very clearly how I go about things, and for those that are familiar with the processes that I use, that the selected sectors in the US I still think offer terrific value and terrific upside over time. Let's just have a quick look at the Aussie market. Our index ended up higher by 47 points for the week. The difference between here in America is really just a bit of a timing issue. The Australian market is still in a strong downtrend. There's really no question about that. Valuations have improved. We've got the banks are lower by 15 to 20%, so valuations have improved, but they still don't reflect the poor economic situation that Australia is facing. And I still have some major concerns over our banks. Some of the great stocks in Australia are coming back into a marginal valuation range. They've been excessively overvalued for some time. They're now getting back to an area where I would consider buying them, but they still don't offer anything like the value that can be found in America in the same sectors. So let's have a look at a few charts. We'll start with the S&P 500 index. This is the monthly chart that we've been watching. And you can see that the uptrend there is clearly still in place. There might be just a little bit of a cooling off. As you can see, the last 4 or 5 months, this little period through here hasn't really done much, but it's still well above the moving averages, and that uptrend is still intact. Let's just zero in on the dailies. You can see the last time we dipped significantly below the red 150-day moving average line was October last year. Since then, that 150-day moving average has really been a strong support point. And so it was last week. The market dipped to it on Tuesday, but managed to recover And it's, if you look at this period through here, let me just put a bit of a block around that. So if we look through this period through here, which started in February, so mid-February through to now, the market really hasn't done anything. It's just sideways, and that's why having a very robust selection and entry and trade management approach is been absolutely critical. Otherwise, you're just not able to make any headway at all. So that's the American market. For both fundamentals and technical reasons, I believe the ultimate breakout should be to the upside. However, as I said earlier, I don't discount the possibility of a sharp dip to the downside if the market gets a bit frightened about some of the triggers that I spoke about earlier. Turning now to the Australian index, the ASX 200 index, and again, I reinforce this all the time. I think this index, if you're following this and you're taking your cues from what the Australian index is doing, I think you're wasting your time. I think the Australian ASX 200 index is, in terms of representing the Australian market, is largely meaningless. It's just a reflection of how investors see the banks and the major miners, and of course one of the major impacts on the Australian market is what overseas buyers are doing, and their motivations are not necessarily tied to to fair valuations or anything of that nature. They can be making asset allocation decisions based on a whole bunch of reasons which we wouldn't even consider, that could be related to currencies, etc. So if you're following the ASX 200 and making investment decisions based on, whether it's going to be above or below 6,000 points or whatever the number is at the end of the year, then I'd really encourage you to stop doing it, because I think it's going to mislead you greatly. Learn to be a stock picker. That's very much a stock picker's market these days. So you can see we're still in clear downtrend, and with the outlook for Australian bank prices, I'm not saying there's anything wrong with our banks, but to be paying top dollar at a time when so many factors are going against our banks in the next couple of years, relating to bad debt provisions, relating to the requirement to hold more capital, then I just don't think it's a very wise thing to do. So that's the Australian market. Let's move on to the Aussie dollar. We're stuck in a range in the Aussie dollar between 76 and 81. I believe that's temporary. The RBA will almost certainly have to lower rates one more time and possibly twice more this year. So I think a cash rate below 2% looks an absolute given. And over the next couple of years, we could even see down at 1% is possible. Things just really aren't going well in Australia. So the fundamentals to me on the Australian dollar would dictate the low 70s as a minimum. And that would be right now. I think that's where the Australian dollar should be right now. And the possibility over the next couple of years that we could see the Australian dollar back in the 60s. So I think that's very possible. Turning to gold, gold was higher by $10 for the week, but the big overall downward sloping wedge pattern that has been in place now for nearly 2 years is still in place. So there's no change. Stock indices, as we'll see, look even worse. So if you're holding gold stocks, then you're probably having a pretty tough time of it. But I would add that June is the seasonal low point for the year for gold and for gold stocks. Now, there's a number of reasons for that. And the main one is that demand in the second half of the year, as we go into the Northern Hemisphere summer, come out of the Northern Hemisphere summer, demand rises, but supply is effectively fixed. The amount of gold that's being produced around the world doesn't vary very much from month to month. Gold mines just keep churning it out, irrespective of what the time of the year is. So supply is fixed, but demand rises from June onwards. So I'm not saying that that's a reason to buy, but I just make that observation for traders. If you're more of a short-term trader, then you might want to keep a closer eye on gold stocks because they're pretty much unloved and out of favour at the moment. So there's a couple of questions here. Has the extreme Fed policy since they introduced QE3 in 2013, has that overridden the normal seasonality? Is this a new normal that we're now seeing? And you hear that term a lot. My view is that there isn't enough evidence to support something that's existed for decades, if not centuries, and that's the seasonality of gold supply and demand. I don't think you could draw that conclusion as yet. So from my perspective, gold is stretched way out of kilter with the fundamentals, and therefore there's a good chance that it will return to a more normal trajectory. However, at the moment it's out of favour, and I wouldn't be moving on it until you start to see some evidence. Copper eased further to $2.68, and that's really just moving up and down with the US dollar strength. Crude oil stayed steady over the last couple of weeks around 60, but I do expect crude oil to be lower yet. The excess supply hasn't been washed out. And there's the spot copper chart that I normally show each week. Let's just have a quick look at the gold situation. So this is the gold chart on a weekly basis. So we bottomed in June of 2013, so exactly 2 years ago. And since then it's gone sideways. It's made a couple of attempts to blip up, but you can see lower highs all the way through here. And we've actually got some lower lows as well. If we break 1136, then that's going to bring in a lot of technical selling. And I think then $1,000 is very much on the cards for gold. So you've got to look at that chart, and you can make a case for seasonality and all the rest of it, but you've got to look at that chart and say that there is definitely downside risk in the gold price. Now, if we look at the HUI index, which is the index that I use for tracking what's happening with sentiment towards gold prices, gold stock prices, you can use the GDX index if you want, but you can see that this has been pretty ordinary over the last few weeks. It's certainly done worse than gold has. So worth watching if you're a short-term trader, but otherwise stay away from the gold market is my view. So overall, nothing has changed here. You should be exercising extreme caution with respect to the Australian market. You should only be considering to buy when you've got a significant edge, which means the price needs to be substantially oversold. And I just wouldn't have a great deal of exposure to the Australian market at the moment. I have some significant concerns. The odds favour the US index breakout to the upside, and again, nothing has changed. It's just zero in on the sectors that are going to be the most resilient from the strength of the global economy, and make sure that you're buying great stocks, you're buying great value, and you observe all the other parts of the process. So that's it for this week, and as usual, for non-members, if you would like some more information about what I do and how I may be able to assist you, then there's the website and email details. That's it for this week. Cheers.